Hi, welcome to the Devon webinar. I'm Greg Smith, Head of Retail here at Devon, joined today by Tama Willis, Portfolio Manager of the TT Fund. Hi Tama, how you going?
Hey, Greg.
Great to have you here, and great to have you along as well. Now, Tama, you've just back from China. See,
Yes,
always in the news, China, isn't it? But
absolutely.
I suppose one thing, investors might be thinking that the growth has been a bit disappointing. Particularly following the reopening. Obviously, there were lots of expectations. What did you sort of glean from your trip?
Absolutely, and that's something we've got very clear indications about why that's the case. China obviously locked down the back end of last year into early this year, came out of lockdown, anticipated that consumers would spend a lot of that surplus cash they'd had. The reasons they haven't been spending quite as much as people thought has been 5 key reasons we picked up over there. I suppose the COVID lockdowns. There really aren't the safety nets in China like here. And in the US, there was a big splurge of support payments. That simply didn't happen in China. So the second reason, as those services businesses have opened up, it's taken quite some time for individuals who have been impacted by lockdown over a couple of years in some cases to then go back and make money and start spending again. So that's a process that's sort of happening now. Thirdly, youth unemployment, because of the lockdowns for the last couple of years, also because the government's been a bit harder on the private sector and has been supporting the state-owned industries, there's been less hiring of a lot of the university graduates over the last 2 or 3 years. So youth unemployment is running at 16 to about 20%. So that's a high number, which sort of tells you that every second household, Chinese families often, in cities at least, you might see different generations in the same household. Quite a number of households are running with someone unemployed in the house, a young person. That dampens sentiment. Fourthly, property. A lot of the middle class in China, property's been the big form of wealth creation for multi-decades. The government under Xi's big focus on properties for living, not speculation, and trying to ensure there's no big property bubble which then breaks the economy. That's kept property prices very subdued, has kept activity somewhat subdued. Consumers are a bit nervous about that. And then finally, geopolitics. You hear all this stuff in the press about US, China. Well, the locals are feeling that. They do take note of it. They are not. I didn't pick up any animosity at all. I felt very. It's a great place to visit, and I felt very at ease. But it's just interesting. Those are the sort of 5 things that are making the consumer a little bit disappointed. The Chinese government had a target of 5% GDP growth. It looked to be tracking well ahead of that. Now, if they don't do something, it could well track below that.
Yeah, and so that leads to the question then, to hit that rate that they were targeting, what might we expect in the way of stimulus? I know that they cut a couple of rates recently. Is there more to come? Or?
There's been a lot of noise and some action, but relatively limited at this stage. And I suppose what you have seen, as you said, you've seen rates being cut. You've seen some localized property measures around reducing down payments, stimulating a little bit, relaxing, trying to underpin property. You've also seen things like EV subsidies extended, some consumption initiatives. But so far, the way that it works in China is, you've had the state council, a larger group of the Communist Party, come together and meet and say, we have to be more forceful on growth, we have to stimulate, we have to do stuff. But ultimately, it's the Politburo, Xi and his 6 powerful colleagues, 3 of which actually are his former chief of staff in some form or other when he was a regional governor. So it is stacked with, as you imagine, with Xi's politicians very close to Xi. Now, the big question is when the next group of economic data is released, potentially mid-July or during July at some point. If it disappoints, the Politburo meets shortly thereafter. What do they stimulate? How much do they stimulate? Do they stimulate property enough to support commodities? These are all the big questions. When we went during the trip, we came away with the conclusion that everyone is so negative that there probably is some upside by the fact that a lot of the steel mills didn't really have many iron ore inventories. People were pretty bearish. It gave us the sense that any stimulus could actually mean some upside in markets. We've had that bounce somewhat. Now the question is, do the government do enough to see the next leg of commodity price recovery?
Yeah, and that's the question, isn't it? So what's the takeaway for the resource sector? Obviously, we hear a lot about iron ore, but
yes,
obviously other commodities.
Yeah, I think
as well.
I think the the takeaway was, that the market was very bearish. Everyone was positioned for iron ore price to go down. So actually what's happened is it's bounced somewhat, and we did buy some during the trip. It's added to our position in iron ore simply because the negativity wasn't backed up by the actual supply demand numbers we were seeing on the ground. Simplistically, which is a little bit technical, but in China, of the 1 billion tons, around 80% is produced with the blast furnace, which needs iron ore and coal in a blast furnace with limited scrap. 20% is scrap based, which is just scrap in an electric arc furnace, which is what BlueScope Steel is doing out in Auckland here with the conversion. Now, scrap generation has been very low because of COVID. People haven't been searching for scrap. There haven't been buildings being demolished. So actually scrap, steel production from scrap is much lower. That supported iron ore demand. So actually the iron ore market, we think, supported about 100. It's currently 110 to 115. Now, for it to go lower, you probably need to see the government disappoint on stimulus, which is a possibility. So, we've certainly added, but we're not aggressively overweight iron ore because of that reason. This requires a macro government intervention. Where we can sort of see long-term tailwinds, EVs in China, 40% of total sales, going to 80% potentially by 2030. So they have a massive acceleration in EVs. Global renewables, with renewable output, electricity, a big growth area in China, but elsewhere. We're also seeing big opportunities with the IRA, the US Inflation Reduction Act. There's $400 billion of tax breaks and other opportunities there for companies investing in renewables. There are regional subsidies, which add up to over $1 trillion potentially. There's the European Green Deal. So there's all these acceleration of opportunities. So if you're looking in the very long term, you'd say copper, which has a much higher weighting in electric vehicles, a much higher weighting in transmission networks, will be is a potential bull market in the offing. It'll take some time, but I think copper looks much better long term than iron ore. Lithium's very interesting. It's just how the supply side develops. There's a lot of new supply coming on, but there's a lot of demand. How that balance plays out, we're doing a lot of work on that market. Probably another opportunity I see is certainly for some of these businesses like Infratil with their Long Road, the US asset. You see opportunities for Macquarie with that sort of $1 trillion tax breaks and opportunities. Macquarie's obviously driving into the green space aggressively. So we sort of see some commodity opportunities. We see some broader company opportunities and names that we're already invested in. And we see a lot of areas to do additional work on. A lot of the commodities obviously depend on partly, particularly copper and some of the metals, on what's happening in the US and Europe. We're seeing quite weak economic data, at least in the manufacturing side in those economies. We're still seeing services hold up. At some point in the next 12 months, you'd expect economic data, manufacturing to bottom, and for probably a more supportive environment more broadly for commodities. So time will tell on China. I think if you knew the answer to the level of stimulus the government was going to throw into the mix, you'd be very well positioned. So it's a guessing game at the moment, but I think we're broadly we can see both sides, but I think a lot is baked in of negativity into the resource sector at the moment.
Okay, well, thanks for your insights there, Tama. That's and great to obviously hear, having been there and experienced China and so on. So yeah, really appreciate that. And it sounds like some opportunities may accelerate in months and years ahead. So time will tell, as you say. But yeah, thanks for your time.
Great, thanks.
You're very busy, and thanks for joining in, everyone. Look forward to bring you another webinar in the near future. But in the meantime, have a great day and have a great rest of the week. Bye for now.